Another very good New York open strategy is the break and the retest strategy. So basically, after the market opens, there's a huge bar or there are consecutive bars to one direction, but after that, the market goes within the range defined by the bar and the consecutive bars. And then this forms a value zone or a range. Then the strategy is to wait for the market to break the zone or value zone and then to one side, either up or down. Then there will be a very good trading opportunity. Let's take this chart for example. After the market opens, there is a bear bar. This bear bar has a very big tail at the top, and then this bear bar is larger than the left bars. Next, the market goes up with 3 consecutive bull bars. So at this moment, if we use the top of the first bear bar and the bottom, we can define a range or value zone. Then this is the strategy for New York Open break and the retest. What we are going to do is to wait for the market to break either the upside or downside. If it breaks up, then we'll go up and buy, and then otherwise it breaks down, we'll short. This is what happened next. We can see that this market is breaking down the range to the downside, and also it's breaking down with consecutive bear bars here. Consecutive bear bars means strong market, strong trending. There are 1, 2, 3, 4, 5, and also the last bear bar, you can see that it is huge. This is a strong breakout of the range. Next, we can see there's another bear bar. It's like a doji bar or hammer or whatever. But what the characteristic of this bar is, it has a big tail at the top. So this is the bear bar pullback, and at the same time, this big tail at the top is to retest the bottom of the range. This is very important. We want to see the break and the retest. This is our strategy. And also you can see that this tail didn't even reach the bottom of the range. It means the strong breakout. So this strategy forms the setup. Next, we want to trade down. Then how to trade this? If you take this bar as the pullback and at the same time it can serve as a signal bar, then you can put your entry at the bottom of this bear bar, and then next bar is gonna give you the short position. This pullback is a bear bar, but it's not necessary to be a bull bar for the pullback because it depends really on how strong the trend is. If the trend is very strong, so based on the understanding of this pullback, the very big tail, it can serve as the pullback. And also at the same time, this is an inside bar. Inside bar means trend will continue right after this with a higher probability. So that's why after you see this, this serves as the signal bar, and then you can go trade for short position. If on the same chart, there are other indicators helping you to do the confirmation, you can leverage them. For example, in this chart, we can see there is a pivot level here, PP, and also there's a S1. So here's the rule to use the other setups or indicator. If the other setup or indicator confirms the same direction, then that means it increases the probability of going down in this situation. But if the other setup or indicator indicates the different direction, then you want to hold and analyze whether you want to trade that direction. In this case, we can rate that this bear bar with the big tail at the top tests not only the bottom of the range or the value zone here, but also the PP here. You can see that it peers a little bit and then reverse back. That means it respects this PP as well, and then there's a downside pressure. So this is also kind of a break PP and then retest PP. So this increases the downside probability. Then you're right now very sure that you want to short. This is what happened next. We have a bear bar and then followed by another bull bar. So basically this bull bar, you can see it has a big tail at the top. So how to read this? This bull bar is another time to retest the range, bottom range of this value zone, as well as the PP level here, but it failed. You can see that it didn't even touch them. And second, previously we have a bear bar, very small bear bar, big tail at the top. If you treat this, that this is the whole leg here, the leg is not finished, what you can do is that when you see this bull bar, this is the real pullback. If you treat that way, then you wait for another signal bar to go down rather than entry here. So whichever way, it's good. But one thing you notice is that in the real trading, you see this bear bar first. Sometimes if you don't put your entry here, the market can go down a lot without a pullback, so you miss the trade. That's why you want to be very cautious whenever you see this, whether you want to put your trigger based on your own decision. For advanced traders, when you put the trigger here, you have some position, and then you see this pullback, you realize this is one leg, and then you can add some more position after this pullback finishes when you see a signal bar. Here's the next bar. This bear bar is very good bar here because the body accounts not 60% but 50% of the candlestick. So in this case, like I said before, we can treat this bull bar as the pullback and then this bar as the signal bar. After this bar finishes, you can put your trigger or your entry level at the bottom of this bear bar to enter the market. This is what happened afterwards. You can see that if you put your trigger here, so your risk is at the top of the pullback here. And then your entry level is the bottom of this signal bar. This is your also break-even level. And then in between, this is your actual risk. If you use the measure move to scalp for one risk, downside, you can see that you can measure the same distance and then this is your exit level. Two things to notice. First, not all the trend will give you 3 legs. In this situation, we can treat this as the first leg, pullback, and the second leg, and then the market reverse. Later on, it just consolidates. Second, how much profit you want to take. In this case, it only goes by 1 time of the risk. Sometimes people want to trade or take the profit as larger than 2 or 3 times of the risk. So in this case, it may not give you the profit, and then later on, you may end up being just break even.